Over the last 35 years, the Greek stock market has gone through crises, recoveries, and major structural changes. In this report, we analyze the long-term performance of the Athens Composite Index, focusing on returns, volatility, risk-adjusted performance, and portfolio construction. Most importantly, we try to answer one question: what does the history of the Greek market reveal for investors today? My name is Panagiotis Moutsiopoulos. I am a graduate of the Department of Accounting and Finance at the University of the Peloponnese, an affiliate member of the UOP Finance and Investments Club, and an incoming master's student in wealth management at the University of Luxembourg. In this presentation, we'll begin with an overview of the Greek equity market, then move into long-term performance and risk analysis. After that, we'll examine seasonality patterns, compare Greek equities with other asset classes, analyze the relationship between Greek stocks and bonds, and finally explore portfolio construction. The Greek market has historically been heavily influenced by economic cycles and periods of financial instability. However, recent years suggest a potentially more stable environment for investors. This report was created to better understand how the market evolved across different periods and what lessons can be learned from more than three decades of market history. The report reveals several important conclusions. First, the Greek market remains highly concentrated in the banking sector compared to broader European markets. Second, despite delivering positive long-term growth, the market experienced extremely high volatility and deep drawdowns. Another important finding is that the post-2015 period appears potentially structurally different, with stronger returns and improved risk-adjusted performance. Finally, assuming a Greek government bonds, Greek equities portfolio mix, bonds continue to play an important diversification role. However, the efficient frontier in recent years suggests a greater allocation to equities compared to the past, reflecting an improved risk-return profile, whereas earlier periods favored near-exclusive bond exposure, although bond allocation still remained dominant overall. Let's begin with an overview of the Athens Composite Index and the structure of the Greek equity market. The Athens Composite Index is the primary benchmark of the Athens Exchange and includes the largest by market cap and most liquid Greek companies. One of the most important characteristics of the index is its concentration. A relatively small number of large companies, especially banks, account for a major part of total market performance. When we compare the Greek market with the Stoxx Europe 600, the difference becomes very clear. Banks account for roughly 40% of the Greek index compared to around 14% in Europe. European markets are far more diversified across sectors such as industrials, healthcare, and technology. Now, let's examine how the Greek market performed over the last 35 years. The Athens Composite Index shows a highly cyclical pattern. The first major market surge occurred in the late 1990s, peaking in 1999, before experiencing a sharp correction shortly afterward. A second expansion followed before the global financial crisis, and the Greek sovereign debt crisis pushed the market into a severe decline. Although the market has recovered significantly in recent years, it still remains well below historical highs. A €100 investment in 1990 would have grown to approximately €462 by 2025. However, this growth came with enormous volatility. At certain points, the investment exceeded €1,200 before collapsing during crisis periods. The Greek market demonstrates extreme annual return dispersion. There are years with returns above 100% and others with losses greater than 60%. Despite the volatility, around 64% of years were positive overall. This suggests a long-term upward bias in the market. However, the dispersion of returns remains high. When we divide the market into different sub-periods, we observe a major difference in performance. The sub-periods beginning in 2005 and 2010 can almost be described as lost periods for the Greek market, largely due to the global financial crisis and the Greek sovereign debt crisis. However, after 2015, and especially after 2020, returns improved significantly, suggesting improving market conditions. Performance is only one side of the story. Now, let's examine risk. The data shows a gradual decline in both volatility and downside risk over time. During earlier periods, the Greek market experienced extremely high levels of uncertainty and potential losses, whereas more recent years show much lower volatility. This chart illustrates one of the most important aspects of the Greek market: drawdowns. Following the debt crisis, the market lost nearly 90% from its highs. Even today, the market has not fully recovered to previous peak levels. Next, we evaluate whether investors were adequately compensated for the risks they took. In earlier periods, losses were generally larger than gains. But after 2015, the situation improved significantly as positive returns begin to dominate not only in frequency, but also in magnitude. Risk-adjusted performance improved substantially in recent years. Sharpe and Sortino ratios increased, suggesting that investors are now being compensated more efficiently for the risks they take. Let's now explore whether the Greek market exhibits seasonal patterns. Looking at the monthly data, we can observe some recurring patterns in market performance. April and December historically show the highest frequency of positive returns, while March and June tend to underperform. Overall, positive months slightly dominate over the long term, suggesting a mild upward seasonal bias in the market. When we examine average monthly returns, April once again stands out as the strongest month, followed by January and July. In contrast, August and September deliver the weakest average returns, reinforcing the pattern of mid-year weakness in the Greek market. Seasonality is also visible in volatility. April combines high risk with high volatility, creating a high risk, high reward profile. The Sharpe ratio analysis confirms these seasonal patterns. April, July, and December deliver the strongest risk-adjusted performance, while August and September produce the weakest results. Overall, the data suggests that the Greek market historically performs more efficiently during the beginning and end of the year. Next, we compare Greek equities with other major asset classes. Bitcoin delivered extraordinary returns but with extreme volatility. Gold and green government bonds provided much more stable performance, while Greek equities displayed stronger cyclical behavior. Gold achieved the strongest risk-adjusted performance during this period. Greek bonds also delivered attractive risk-adjusted returns. Meanwhile, Greek equities provided solid returns but with significantly higher volatility. The correlation analysis highlights diversification opportunities. Gold shows very low correlation with most assets, making it an effective diversifier. Greek equities remain strongly linked with European equities, while the relationship between equities and bonds gradually weakens over time, as we will see in the following section. Next, we examine the relationship between Greek equities and Greek government bonds. The correlation between Greek equities and bonds changes significantly over time. During the debt crisis years, correlation increased sharply, reducing diversification benefits. However, in recent years, correlation declined substantially, suggesting that the bonds have gradually regained their role as a diversification asset. The downside risk analysis shows that equities consistently exhibit higher tail risk compared to bonds. During crisis periods, Greek equities experienced larger losses while bonds remained relatively more stable. More recently, downside risk improved for both asset classes. The daily return chart highlights the higher volatility of equities relative to bonds. Meanwhile, the rolling retail analysis shows that equities became increasingly attractive after 2017, particularly in recent years, where returns strengthened considerably compared to bonds. Volatility remained consistently high for equities throughout the entire period. The debt crisis years produced extreme levels of uncertainty, especially between 2012 and 2016. Although volatility declined significantly afterward, equities still remain riskier than bonds. The Sharpe ratio comparison reveals an important structural shift. Historically, bonds often delivered superior risk-adjusted performance. However, after 2021, equities began generating stronger and more consistent Sharpe ratios. Now, let's move into portfolio construction. Over the full 2010 to 2025 period, Greek government bonds dominate portfolio efficiency. Bonds delivered slightly higher returns with significantly lower volatility, resulting in optimal portfolios being heavily weighted toward bonds. The 2010 to 2015 period reflects the severe impact of the Greek debt crisis. Equities generated deeply negative returns alongside extremely high volatility. As a result, optimal portfolios were concentrated almost entirely in bonds, while equities significantly reduced portfolio efficiency. Between 2016 and 2020, market conditions improved substantially. Both equities and bonds generated positive returns, although bonds clearly outperformed on a risk-adjusted basis. Portfolio efficiency remained strongly bond-oriented during this recovery phase. The 2021 to 2025 period marks a major reversal in market dynamics. Equities significantly outperform bonds both in absolute returns and on a risk-adjusted basis. As a result, the average allocation to equities increases significantly compared to earlier periods, although the average allocation to bonds still remains higher overall. When we compare all three sub-periods together, a clear structural transformation becomes visible. The Greek market appears to be gradually shifting from a crisis-driven environment dominated by defensive positioning toward a more growth-oriented market where equities increasingly contribute to portfolio performance and portfolio allocations, although bonds still remain important for overall portfolio efficiency and weighting. For the methodology, the analysis is based primarily on historical price data from the Athens Composite Index and other asset classes. Annual and monthly returns were calculated using end-of-period closing prices, which were then used to estimate various performance and risk metrics, including arithmetic and geometric returns, volatility, value at risk, Sharpe ratios, Sortino ratios, correlations, and drawdowns. To examine portfolio construction, efficient frontier was generated using Monte Carlo simulation, where thousands of potential portfolio combinations between Greek equities and Greek government bonds were simulated in order to evaluate different risk-return trade-offs across time. The study also compares multiple asset classes, including Greek equities, Greek government bonds, the stocks Europe 600, gold, and Bitcoin, using a consistent return methodology. It is also important to note that exposure to Greek government bonds is proxied through the performance of a government bond mutual fund, which also maintains a small exposure to equities, rather than through a direct bond index, mainly due to data availability. However, there are several important limitations. First, the analysis is based on price indices rather than total return indices, meaning that dividends are excluded. As a result, actual investor returns may be understated. Second, all returns are expressed in nominal terms and are not adjusted for inflation, tax, or transaction costs. Third, portfolio analysis includes only two asset classes, Greek equities and Greek government bonds, which simplifies real-world investing, where investors usually diversify across a much broader range of assets. In addition, historical relationships between returns, volatility, correlations can change over time, especially in markets affected by structural economic shifts such as Greece. Finally, Monte Carlo simulations and efficient frontier analysis rely on historical data, meaning that the results should not be interpreted as predictions of future market performance. Therefore, the findings of this presentation should be viewed as an information analysis rather than investment advice. This analysis will also be posted on the YouTube channel of the University of the Peloponnese Finance and Investments Club. So if you are interested in finance and investing, feel free to check it out there as well, along with more videos and analysis that will be posted on the channel in the future. This presentation was prepared exclusively for informational purposes. It does not constitute investment advice. Thank you for watching. We hope this report provided useful insight into the evolution of the Greek market and the changing relationship between risk and risk over time. And if you enjoyed this presentation, feel free to support both this channel and the UOP Finance and Investments Club for more research and market analysis. The social media links for both will be available in the description below, and feel free to contact us for any additional information, questions, suggestions, or potential collaborations. Thank you.